finance, that's my background. But a lot of people like, well, how do you buy a $40 million property? Well, just like you buy a single family, a $300,000 property, just like you buy a $400,000 property, you're going to have a portion of it as debt and a portion of it that is equity. And that's where you come in. So, as I was saying, it's an aggressively discounted property. We bought this property for $40 million. The owner purchased this property at $46 million. The seller originally purchased the property at a much lower cap rate also than we're purchasing it. So the local synergies that we have, these properties are next door to multiple other assets that we own, as well as our property management with thousands of doors throughout Texas, Florida, Georgia, Tennessee, Alabama, and Arizona, allowing for more synergies and value creation. So because our property management is so interconnected in these markets, we are able to really work with them big time. And I'll tell you about one of the properties that we're about to purchase in Alabama that makes this really, really exciting because of the property management that we've aligned with. So, as I was saying, it's a conservative approach in a volatile insurance market. I touched on that at the very beginning. Right now, after COVID-19, for some reason, there's been a lot of just insurance craziness happening. And with the insurance craziness, that that's happening, it just is increasing insurance exponentially. Some insurance has gone up 70%. Some insurance companies have even moved out of certain markets, like Farmers is not in Florida anymore. So this means that people have to start getting very creative. And one of those creative ways that we have found is aligning ourselves with a property management company that has 15,000 doors. And because of those 15,000 doors, they can get us on their blanket insurance policy. One of our sponsors is Venkat Aramoli. He and his sister Raja have together well over $50 million in assets under management and have actually had well over $100 million in assets under management with thousands of doors. So we are so excited to be aligned with Mr. Venkat Aramoli, but he's one of several of our sponsors. So when you think about, well, who's at the helm? I have single family experience. I have small multifamily experience. I have 3 decades of experience, but it is for me to align myself at the commercial level with with other sponsors that have done this for decades as well in the commercial space. We also have our asset management team and our underwriting team. And our underwriting team and our asset management team, these are team members that kind of go and come, they interchangeably. So asset management is still something that we're working on. Our underwriting team, this is changes with from deal to deal. So this is just an example of one of the teams that we work with, Hudson Communications. They may provide some technology for this property. And as of right now, they've given us a quote for about $80,000 for a solar company that wants to come in and rent out, lease the carport roofs. So that's a one opportunity that we have with Hudson Communications. So here is our investment overview. Again, the buy income strategy with CEF, Clearview Eastern Fund, is a multi-asset portfolio with the benefits of diversification, the benefits of mitigating single asset risk. I want you to think about, if you buy a business, I want you to think about if you buy a business, if you if you not only if you buy a business, but if you buy an apartment building that is in your area, if you like I have bought things just in one single market, focused only on Jersey at a time, and then I got burned. Focus only on New York, I got burned. So what's nice is when you have a multi-asset portfolio that you're invested in. We have properties that we are looking at and that we are acquiring. We have current assets right now in Phoenix. We have current assets right now in Atlanta. We have current assets right now in Phoenix, Atlanta, and in Raleigh, North Carolina. This is where we have assets right now. We are adding additional assets in San Antonio, Texas, as we just talked about. We are adding additional assets in Birmingham, Alabama. We are adding assets in very strategic markets. And in these very strategic markets, these are markets that corporations are moving to, markets that people are moving to because the rents are lower and they have stabilized returns. So here is the current acquisitions that we are talking about today. We talked about Mission Medical. This property just started being built in 1979, and they built the last building in this complex of several buildings in 1985. It is at 5611, I'm not sure, 5611, 5622 Everest Road in San Antonio, Texas. We are also just literally this week got into contract on Serenity Apartments, which is 210 at Valley Creek. And this is a beautiful community, 104 doors. It's a beautiful Class C property, and we are just getting an amazing deal, buying at over a 7% cap rate. For those of you that are in real estate, you know that's really, really good. I think we're buying at a 7.6 cap rate at $6.5 million for this 104 unit apartment complex. We are also considering a purchase of Sunrise Apartments, which is also owned, also owned by this same owner. That contract is not sealed yet. But here's what's nice. Because of that multi-asset portfolio that I just described, we are able to see a 10% cash on cash return on our investment. So our cash on cash is exclusive because we have an exclusive portfolio opportunity at a strong purchase price for every single property that we are acquiring. We have high growth locations and steady rental demand, which gives our investors a 21% IRR or better in our portfolio. So here's one of our property managers that's going to be considered for as I was saying, for the San Antonio property, Devonshire Property Management. We are strongly considering them. We're still taking applications, but strongly considering Devonshire because A, they have over 15,000 doors in Texas, and B, because they're able to get us a very discounted rate on the insurance. So the insurance difference, what we noticed in our pro forma is that we are actually paying a higher $400 per door higher insurance than the previous owner. And the reason for that is a recent hailstorm. And there was also a building that burned that is currently being erected again. And so because of those two things, we saw that the insurance is going to go up for our acquisition. So it's very important that we align ourselves with a company that can put us on their blanket insurance with over 15,000 doors. And so we have received an insurance quote much lower than the quotes we were getting without that property manager. So strategic partnerships are key. So, as I said, the property is 453 doors. It's 2 stories, garden style. Now, let me tell you a little bit about why we buy garden style apartments. We buy 2-story garden style apartments because the maintenance is much lower. The cost of maintenance is much lower. The cost to manage this property and expenses and everything averages about 50% in this market. It's between 50 and 55. 50 if you're really good at managing your asset, 55% if you're not that good. This property is being managed at 58% expense ratio, and that's because they're just bad management, which is why we have a huge opportunity here. We're buying a stabilized asset that's only 89% occupied. Actually, last we checked, it's 87% occupied. So we're able to get this property up to 90% occupancy, maybe even 95% occupancy, and that will increase our income. So here's what's nice. The average rent hasn't been bumped either. All of the properties in the area are averaging, that is the same, actually older than this property, 1968, 1970, that are right next door, are charging $1,138 average for their apartment rents. And the average rent on this property is only $985. So this is how we find stabilized assets. I hope you're following me. This is a stabilized asset. Is it going to make money? It's been making money since 1979. Is it going anywhere? No, it's not. Right? So, no, it's not. So the only difference, the only thing that we can come and do in coming in, buying a stabilized income like this, is look at the previous management and say, okay, well, you didn't raise rents consistent enough, so your average rent is only $985. You're missing $150 in rent. Hey, you didn't evict these people fast enough. You're missing out on money. You're not advertising to the 5 medical facilities in the area. You're missing out on money. You didn't keep the pavement beautiful. You're missing out on money. And this is how we are able to buy stabilized assets and increase the income. That's why we love apartment complexes. So there's opportunities to further drive value. We have, as I was saying, we're going to upgrade the cabinets. The cabinets have not been updated. All of the apartments are beautiful. There's actually 18 different models of apartments in this complex. However, the cabinets have only been painted, so we have very simple things we're going to do to update it. Just changing the faces of the cabinets, which is just the doors. You don't have to replace the whole cabinet. We don't need to replace the floors. They're beautiful. We might replace just the sink knobs and maybe the Formica cabinet to some other kind of cabinet, maybe quartz. So all of these things are currently in discussion with how we are working, because quartz is actually I believe quartz is cheaper than granite. Don't quote me, but this property is right next to the San Antonio Aquarium. It's right next door to the Home Depot and several other things. In the community, you've got all kinds of amenities. Again, there is a beautiful soccer court that's there, completely not maintained. No one's using it. The grounds are ugly. There's rocks all over the place. So these kinds of amenities, when we freshen up the community, make it beautiful, repave the parking lot, just some really cute face uplifts, we will maintain our asset and be able to increase the value of the property. So as beautiful as this picture of this playground looks, this is another, this picture just pops. It's that same playground and that's the way the playground looks. However, I can tell you those colors on that playground are really dull. The greenery is also very worn. It's not gorgeous. It's not as beautiful as that picture. Pictures these days are so high definition, they just make everything look great. but I can tell you that that playground when we walk the property is not as bright, and this is where we can add value. This is one of the newer apartments, and so there are some models that are new like this. In the new building, there's going to be new model apartments, and the classic model apartments are not actually on this sheet, but this is an idea of how beautiful the property can look, and these apartments are already getting this rent that we are discussing right now. So as I said, in the area, there is nothing but retail shops, all kinds of retail shops, and thousands of jobs. We are right in the middle of interconnecting freeways down the street and 5 major hospitals. So excellent submarket demographics over here. Young single professionals equal 54%. So since this property has mostly 1-bedroom apartments, this is fantastic that, we have 54% young single adults. Most of the neighborhood is renter occupied households, 69%. As I said before, the average rent is $1,138 and the average income is $44,000, and there's over 192,000 jobs just within 15 minutes of this property. So yeah, people need places to live. So now we talk about the investment details. As I said, this is a 506C. This is a Class D 506 C offering. And what that means is under Regulation D, you do have to be an accredited investor to invest with us. This property actually, let's see, is what we consider a Class B property. And Class B means that it's in a great neighborhood. It's in a great location. The average person is just a little bit more. They're both working class. And there's even some Class A buildings in the neighborhood, just right down the street. So there's Class A in the neighborhood, and this is considered a Class B property. Right now, it's more like a B minus. When we do our updates, it'll go to a B plus. We project a hold period of, actually, this is a little bit off with the refinance. It's actually correct. The refinance anytime within the next 1 to 3 years, we're going to get out of our bridge loan. And then at that time, we'll be in for the ride. That this is a property we're going to hold long-term for our families, and we have no intention to sell, but we do our figures based on a 7 to 10 year hold so that we can give you that 22% projected returns. And our equity multiple, you can see easily within that first 3 to 5 years, a 2x multiple. It's 3 to 5 because that's going to depend on when we refinance and how quickly we can go ahead and turn all of the apartments. So we give ourselves a 3 to 5 year margin on that because we want to get in with the bridge, stabilize the property, and then what's nice about something that we're able to offer all of our investors is a 6 to 8% preferred return from year 2 forward, no matter what's happening with the property. And that's something we've just secured. So 6 to 8% preferred returns. Talk to your investor relations representative about that. No matter what the numbers say, we are able to have a 6 to 8% return. And that's because we are have our proprietary strategies that we are using to get multi-faceted multi-assets in this portfolio that allow us to do some pretty special things. Okay, so it's a two-tiered return structure. So as far as we're concerned, we're not going to take a dime from any of the net operating income on any property that we work on, besides our fund fees, our 2% fund fees. So we work for you, okay? And our incentive is to make sure that each and every one of these properties cash flow. And so once we can get it to cash flow, at that point, we go from you, the investor, owning 70% of the property and us only owning 30%, to you, the investor, and us, the operators, 50-50 waterfall. And, all of those details will be explained to you by your investor relations representative. Just get back to them right after this call and learn more about how you're going to get 6 to 8% preferred returns. Everything is spelled out in our investor portal, and it's pretty simple. So our planned renovation costs are about $2.3 million on this property, and sources and uses, you can go all over all of this with investor relations. But the next steps is review our offering in the investment portal. E-sign your documents right in the investment portal. Now, the investor portal is at clearvieweastern.com. Click on View Deals, and you can go through all of the details there. And then fund your account. You can link your bank account to the account and fund that way. If you have a self-directed IRA, a 401k, or anything like that, or any other entity you're investing with your trust, get with us. We will walk you through the process. We work with all entities as well. And then we close. We are closing actually sometime by the end of next month. So this is going to be a lot of fun. There's not a lot of time. And the end of next month is it's a worst case scenario. So you definitely want to get with the person that brought you to this call and thank them. And when you see them, give them a hug. This is Tené Williams. I will take questions now. Does anyone have any questions? Please put your questions in the chat room here. And we will take questions. Okay. Well, please get with the person that invited you. And thank you again. We'll see you next week, Thursday. And once again, I just want to let you know, are you in? Sign your documents. Get your accreditation letter, because that is required. Fund your account. But before I go, I just want to remind you about everything that we talked about. What is this about? Why do you buy income? Because with AI and automation, it is absolutely guaranteed that in order for you to mitigate your family's risk, you do want to find a way to keep your income stable. You want to find mailbox money. And mailbox money, what other type of thing could you invest in that was mailbox money? Of course, there's a lot, because I talk about a lot on the Clearview channel if you go to our YouTube channel. There's a lot of different things you can invest in. But the one thing that I found to be consistent is institutional investors do invest in housing. They buy housing, they always buy housing. We would be considered an institutional investor. And so when you think about housing, you go, okay, all of us have, no matter what's happening in the market, we all have to live somewhere. We know that there is a major housing shortage. All you have to do is just go online and look at the housing shortage. And that brings me to another and the last point. One of our other very awesome things that we're doing is we are erecting an independent living facility, a residential assisted living facility, and a hospice facility. Yes, that takes care of all stages of life. However, one of the wonderful things about that is we are doing that in the fund. I initially was going to buy this income on my own through my own portfolio. And I said, you know what? I think the CEF investors want to see a situation where it's $3,000 for the mortgage, maybe about $5,000 expenses all in, and $25,000 a month in profit. That's what we're getting on our residential assisted living facilities. And on our hospice facilities, we are projecting $45,000 a month. We didn't have a chance to put those facilities in this presentation. But if you want any information on that at all, you will want to give us a call at 407-801-0899 and just ask your investor relations associate and find out how you can be involved, because we do have several opportunities. You can invest in CEF, and CEF, your CEF investment is going to be not only in the San Antonio property, in the Raleigh property, in these residential assisted living facilities. I can only give you the minimums of the projections. If I gave you the maximums, you might think I'm nuts. But trust me, we've got our fingers on the pulse, and we're so excited to see you with us. Thank you for joining us. I'm out.